This is Nightly Business Report with Bill Griffith and Sue Herrera.
Walking away, the chief executive of Wells Fargo is stepping down immediately from the scandal-plagued bank, and his most vocal critic cheers. Next target, should profits be taxed more than earned income? That's what Democrats are asking as they eye higher rates on long-term capital gains. New playbook, how one investor is taking a page from venture capitalists to identify and invest in the next generation of baseball stars. Those stories and much more tonight on Nightly Business Report for Thursday, March the 28th. And we do bid you a good evening, everybody, and welcome. Sue is off tonight. Stocks rose today as trade talks between the U.S. and China resumed. We'll have more on that in a moment, but begin with late-breaking news tonight. A surprising resignation at Wells Fargo. CEO Tim Sloan is stepping down effective immediately. His departure was announced after the close tonight. He is being replaced on an interim basis by the bank's general counsel. Wells Fargo, of course, has been under intense scrutiny because of the fake account scandal of a few years ago, which has resulted in more than $2 billion in fines. Sloan was promoted to CEO and charged with cleaning up the mess, but he is now the second CEO to step down because of it. Senator Elizabeth Warren had been a very vocal critic of Sloan's. She recently called on the Federal Reserve to maintain its growth cap on the bank until Sloan was replaced. After the news, she tweeted this out tonight. "About damn time," she wrote. "Tim Sloan should have been fired a long time ago. He enabled Wells Fargo's massive fake account scam, got rich off of it, and then helped cover it up. Now let's make sure all the people hurt by Wells Fargo's scams get the relief they are owed." The stock initially moved higher in after-hours trading tonight following that announcement. To Wall Street now, and the stock market, where trade was once again in focus. U.S. officials are in Beijing to resume talks between the world's two largest economies, and investors cheered with hope today. The Dow Industrial Average rose by 91 points to close at 25,717. The Nasdaq added 25. The S&P was up 10. Eunice Yoon has more for us tonight from Beijing.
Trade Representative Robert Lighthizer and Treasury Secretary Stephen Mnuchin are in Beijing for their talks with China's Vice Premier Liu He. The Commerce Ministry confirmed that the two sides are going to hold discussions all day on Friday and said that a lot more needs to be done. The Wall Street Journal is reporting that the Chinese side is offering to make concessions to give access to the country's cloud computing industry. Under the proposal, foreign tech firms would be allowed to own data centers as part of a pilot in a free trade zone. This is the second report indicating that China is making offers in its technology sector. Trump administration officials told Reuters that the Chinese have put forth proposals on forced tech transfers that have gone further than in the past in their size and scope. The Reuters report said U.S. officials want to keep at least some of the tariffs for leverage over the Chinese, though whether the Chinese will want to do that seems unlikely. Sources familiar with the talks have told me that the two sides still need to clarify how and when tariffs will be imposed, nail down undefined language, and find a way to make the deal enforceable. Separately, China's premier put a timetable on a new foreign investment law that's meant to end forced tech transfers. He said it would go into effect next January and added, "We will heed the input from various parties, especially from foreign investors, to drive home the message that Beijing is addressing the complaints of its trading partners, including the United States." The Chinese vice premier heads to Washington next week to continue the negotiations. For Nightly Business Report, I'm Eunice Yoon in Beijing.
Well, with just one day left in the first quarter, investors must be feeling pretty good because it wasn't just one part of the market that saw gains, but pretty much all of it. Bob Pisani's at the New York Stock Exchange.
We're about to wrap up the first quarter, and overall investors should be very pleased with their investment portfolios. Even with all this hand-wringing about lower bond yields, it's not just the S&P 500, which, by the way, is having the best quarter since 2009. Everything is up, and I mean everything. The stock market, the bond market. Russell 2000, the small cap index, is up 12%, but bonds are doing great. High-yield bond ETFs are up 6%. Corporate bond ETFs are up 5%. Even treasuries are up more than 2%. That doesn't even include the dividends. So what's it all mean? It means that if you had a portfolio like I just put up with a 60-40 stock bond split, you're up about 9% this quarter. That's very impressive gains for a balanced portfolio. And you've been a winner even if you invest by sector. All 11 sectors are up on the quarter. Technology stocks are the big gainers, but energy stocks were also strong as oil rallied. Industrial stocks, which were dramatically oversold at the end of the fourth quarter thanks to these global growth and trade concerns, they snap back. They're up 15%. This is not bad for 3 months' work. For Nightly Business Report, I'm Bob Bassani at the New York Stock Exchange.
We learned today that economic growth in the U.S. slowed in the final 3 months of 2018. Gross domestic product for the fourth quarter showed a gain of just 2.2%. That was in line with expectations, but down from a previous estimate from the government. And that put full year growth for all of last year at 2.9%. That actually was the best year for the economy since 2015. But Warren Buffett is noticing a slowdown in economic activity. During a wide-ranging interview today, the chairman of Berkshire Hathaway pointed to BNSF Railway, that is the freight rail company owned by Berkshire, that he says is signaling weaker growth.
It looks like it's slowing down. I don't mean it's reversed in course or anything, but it does seem from all of the businesses, but especially including railroad statistics because they come so fast. And they cover such a broad spectrum. And it gets distorted by whether people are hurrying up the Pacific trade because they're worried about tariffs and all of that sort of thing. But I would say that it does look like the pace of increase in the economy has slowed down.
Well, if the U.S. economy is slowing down, it may be in part because economies overseas are hitting the brakes. And today, the vice chair of the Federal Reserve said the central bank must pay closer attention to global growth risks because countries are linked more than ever because of trade and financial transactions. During his speech today, Richard Clarita explained how the U.S. economy could be shocked by a global downturn.
This shock will impact the U.S. through direct trade links, lowering the demand for U.S. exports and thus lowering GDP. Second, the foreign recession would lead to lower interest rates abroad, and other things equal, would tend to raise the value of the dollar, which in turn could have an impact on exports and trade.
And he emphasized that policymakers cannot ignore those kinds of risks. To the housing market now, and today we learned that home buyers signed fewer contracts to buy existing homes in February when compared to January. But mortgage rates have continued going lower since then, and those lower rates have many feeling enthusiastic about the spring selling market. Diana Olick has more.
At a Sunday open house in Bethesda, Maryland,
Go check it out. Go see.
home buyers were taking advantage of warmer weather and lower mortgage rates.
Everything's falling into place where interest rates are going down, the weather's nice, we have some houses to look at, and people are excited.
Things were busy at this 5-bedroom colonial listed for about $1.25 million. But while the supply of homes for sale is a little higher than last spring, the market is still very competitive.
It seems like there are fewer houses on the market that are more affordable, and it also seems that they go very quickly, so within the first couple weeks of showing.
Tanya and her husband Matthew want more space for their young family.
If we look towards the upper end of our price range, it seems like there's more options.
Price is still clearly an issue. While the price gains in most markets are shrinking, the run-up over the last few years was dramatic, and even falling mortgage rates are not making up for it. Pending home sales in February, which measure signed contracts during the month, fell from January and were down sizably from a year ago. The average rate on the 30-year fixed saw a recent peak just over 5% last November, but then began falling slowly. Rates were around 4.5% in February. In the past week, the rate took the steepest dive in a decade, falling to right around 4%. The hope in the housing market is that this latest drop will really juice spring sales, but demand has been strong for a long time. It'll really come down to what today's buyers can afford.
People have been on a knife's edge about whether they can afford a house, and lower mortgage rates mean more buyers. It has had an unusual effect. There's almost no slack in the system. Because wages haven't kept up with home prices, people are having to borrow the money. And when it gets easier to do that, we see more buyers.
And that Bethesda home that went on last weekend went under contract by Tuesday. For Nightly Business Report, I'm Diana Olick in Washington.
And in Washington, a proposal is being floated that has grabbed Wall Street's attention. John Harwood reports that Democrats are looking at raising the tax rate on long-term capital gains. John joins us from D.C. tonight. I mean, it's no surprise that Democrats want to raise taxes on the wealthiest of Americans. So why go after capital gains?
Bill, you know, Alexandria Ocasio-Cortez, the fiery freshman House member from New York, drew a lot of attention with her 70% rate. That's a high rate. It sounds high to a lot of people. Democrats want to draw a contrast with Republicans on work versus wealth. And so they're focusing in on capital gains rates, which are lower, and they're talking about raising them to not as high as 70% in any event. And they think that that is a way to frame in the 2020 campaign a better argument that will appeal to a wider array of voters.
So what proposals are we seeing so far on that?
Well, you've got Bernie Sanders, who wants to equalize the ordinary income and capital gains rates, raise them both to 54%. That's not likely to fly. John Delaney, former private equity executive who's a long-shot Democratic candidate, says, we'll just make the capital gains rate the same as the personal rate now. That's 37%. Elizabeth Warren's got a wealth tax, which is different. But the interesting thing about her wealth tax is what she would do is tax on a mark-to-market basis the value of assets as they appreciate, not just when they're sold, which is what happens under existing law.
Quickly, any pushback within the party on any of this?
Yes. Larry Summers, the former Treasury Secretary, told me if you raise the capital gains rate over 30%, you will actually cost the government money rather than gain it, because selling capital gains is voluntary, realizing capital gains is voluntary depending on sales. If you discourage sales, you'll get less revenue. And so Larry Summers said, what's the point of going that high?
John Harwood in Washington. Thanks, John.
You bet.
Time to take a look now at some of today's upgrades and downgrades. FedEx was downgraded today to neutral from positive at Susquehanna. The analyst there said the stock is going to remain under pressure in the near term without a new source of cash flow. So the price target is now $192, and that stock rose 1% to $177.90. SeaWorld was upgraded to buy from neutral at B. Riley FBR. The analyst calls that theme park operator a leader in its industry and can benefit from improving economies of scale. Price target now is $34. That stock was up a fraction today to $24.68. Monster Beverage was named a top pick at Credit Suisse today. The analyst cited the company's growth potential, and he pointed to slowing momentum at new competitor Bang. Price target $75. Shares dipped to $54.46. Still ahead, startups promise to disrupt the financial services industry, but that's not exactly how it's been playing out. As you may know, Lyft makes its debut on Wall Street tomorrow, and tonight it priced its IPO at $72 a share. That was at the high end of the expected range. That values the company at more than $20 billion. Lyft is one of the most highly anticipated IPOs of the year. Meanwhile, the government is suing Facebook. The Department of Housing and Urban Development alleges that the company engaged in housing discrimination. The lawsuit claims that Facebook allowed advertisers to restrict who is able to see ads on the platform based on race and national origin. The department says that Facebook is violating the Federal Fair Housing Act. Facebook says it is surprised by this decision. Amazon said today it is adding 800 jobs to its tech hub in Austin, Texas. Those positions will focus on engineering and cloud computing. The expansion follows Apple's announcement last year that it will invest $1 billion into a new campus in that city. Whole Foods, which is owned by Amazon, is headquartered in Austin, Texas. The Federal Trade Commission has shut down 4 operations that it said were responsible for billions of robocalls. According to the FTC, the groups pitched a wide array of services from debt relief to home security to fake charities. The agency has been calling on phone companies and wireless carriers to help combat the scammers. And according to the Wall Street Journal, robocallers so far have been fined more than $200 million since 2015. But at this point, the government has only collected $6,700 of that amount. It's no secret that technology is causing rapid changes in many industries. Tech startups are looking to reinvent just about everything these days, including the way we bank. But that industry's evolution is not exactly going as some had planned. Deirdre Bose is in San Francisco for us tonight.
If you ever paid a bill using your phone or opened a savings account online, then you're part of the fast-growing fintech industry, which stands for financial technology.
Fintech startups were widely expected to challenge the traditional banking industry by making it easier and faster to save, borrow, and manage your money without ever even having to walk into a local branch. But that total disruption never happened. And as it turns out, startups and established banks instead are working together.
There's Chase's acquisition of payment startup WePay, Citi's strategic partnership with robo-advisor Betterment, and this week, Apple announced a credit card with Goldman processed by MasterCard.
At the Fintech Ideas Festival organized by the Bank Policy Institute here in San Francisco, large banks and startups are on stage together talking about more collaboration.
I think some time back, when you go back to the launch of Apple Pay and the like, that itself was an indicator that I think most companies understand that in today's world to succeed, rather than try and control everything yourself, the best way to work is through partnerships.
We think of ourselves today as a platform, not a product company, and that's a large part of our growth is based on that definition and that extension.
Experts also say the future of banking involves blockchain, the technology behind cryptocurrencies like Bitcoin. But how and when blockchain transforms the industry is still unclear, even for those banks that have made big investments in the technology.
If I had to bet, I am bearish. Okay. I think that, and I hope that it works. I want it to make us better, but I have not yet seen a use case that tells me I'll be dependent on it in 10 years.
Even the CEO of crypto startup Ripple, which wants to transform the way financial institutions move money around the world, acknowledged that progress has stalled, but says that blockchain will play a central role in banking in a digital future. It'll just take time.
The JPM coin, I think, actually, in many ways, has been great for the industry because, someone who not that long ago was saying Bitcoin's a fraud is now leaning in, and it was a macro good thing for the industry and bringing credibility.
As for what's next, participants here expect more changes to the normally staid financial services sector, and that any transformation will be driven by both newcomers and old-timers alike. Nightly Business Report, Deirdre Bose, San Francisco.
Movado shares are ticking higher, and that's where we begin tonight's market focus. The luxury watchmaker reported better than expected earnings thanks to a 35% increase in sales over the holiday quarter. The CEO said today its lineup of newly acquired brands are helping to boost its online sales, and shares soared by 22% today to $40.06. Accenture reported stronger than expected quarterly results, and it increased its full-year guidance as well. The global consultancy firm cited its push into digital and its investments in cloud services. Accenture says it plans to spend up to $1.5 billion on deals during the current fiscal year, and the stock gained about 5% today to $175.12. Meanwhile, Blackstone is reportedly dropping out of an auction for Nielsen, and reports say that Apollo Global Management is also losing interest in that television ratings company. The auction was expected to be completed this month, but that latest development pressured the stock. It fell 11% today to $23.66. And a lawsuit against Boeing has now been filed over the crash of the Ethiopian Airlines jet. The suit was filed by the family of one of the passengers on that flight. It alleges that Boeing had defectively designed the automated flight control system of its 737 MAX jets. Investors, though, shrugged the news off. The stock gained a fraction today to $374.44. Coming up, the big money in March Madness.
College basketball's Sweet 16 kicks off tonight, and gaming companies and casinos are hoping for some sweet returns. I'm Contessa Brewer. Coming up on Nightly Business Report, how these companies are hoping for a piece of the March Madness action.
Last night, a jury awarded a California man $80 million in damages after he claimed that the weed killer Roundup caused his cancer. The man had used that product on his 56-acre property for 2 decades. Bayer now owns Monsanto, the maker of Roundup. It insists that the weed killer is safe and said that it will appeal this verdict. In the meantime, though, Bayer and Monsanto still face hundreds of other lawsuits tied to Roundup. Well, the Sweet 16 portion of the NCAA men's basketball tournament gets underway today, and so far March Madness has been big money for bookies and in sports books. With sports betting now legal in many states outside Nevada, Contessa Brewer has a look at all of the ways that Americans can get a piece of the action now. She reports tonight from East Rutherford, New Jersey.
For the first time in history, the sportsbook here at the Meadowlands is accepting bets on March Madness and a slew of other sports.
We're all excited about this.
The American Gaming Association predicts 1 in 5 adults will wager a total of $8.5 billion, much of that on those college basketball brackets. But legal sportsbooks are also getting a piece of the action. Big business, surpassing even the Super Bowl. In Nevada, traditionally, March Madness brings in 65% of the sports betting action for the year. Now, a total of 8 states have legalized sports betting, and 30 others are moving forward. Analysts with thelines.com predict New Jersey alone could draw 25% of Nevada's handle. Casinos and online platforms are rushing to cash in. FanDuel now grabs 50% of the market share in New Jersey. CEO Matt King is hoping for widespread regulation.
Nobody should ever kid themselves that, for the need for good, stable, friendly regulation, because if you don't have that, then you can't compete against the illegal guys.
And it's these little devices, mobile gambling, that will drive the profits of this industry. How important is it? In February, Super Bowl, FanDuel brought in $1.5 million through this sports book. But it brought in $6.5 million through online and mobile bets. Just this week, Rhode Island passed a measure into a law to allow sports gambling. And these companies are counting on more states to follow suit.
If you really want to bring the illegal market into the regulated market, that it's very important that they have access to mobile sports betting. That's what they have today.
For investors looking for some direct exposure to the U.S. market, it's not quite as easy as making a bet on your phone. David Katz, gaming analyst at Jefferies, suggests looking to the technology or platform providers or overseas.
The bricks and mortar casino companies don't stand to make the most money from sports betting in the U.S. It's actually the technology and platform providers, IGT and Scientific Games, that are best positioned. And even the UK companies, William Hill, Paddy Power, and GVC, that are covered by our UK colleagues, are best positioned for the U.S. sports betting business.
For now, gaming companies are intent on growing market share and lobbying more states to legalize sports wagers. FanDuel is betting March Madness could wind up making this its best month ever. It's expecting sweet returns for the Sweet 16. For Nightly Business Report, Contessa Brewer, East Rutherford, New Jersey.
And on this opening day for Major League Baseball, we have this story of a former pitcher who is investing in minor league players and stealing a page from venture capital playbooks. Eric Chemi has the story in New York tonight.
While the stock market may be facing volatile times, there's a creative way to get uncorrelated returns. Investing in baseball players. A company called Big League Advance has raised more than $150 million to buy equity stakes in minor league baseball players. The idea is simple. The players get an upfront payment, but it's not a loan. They can keep the money forever. In return, Big League Advance gets a percentage of any eventual Major League Baseball earnings. The company has invested in over 130 players so far, including Fernando Tatis Jr. and Jose Osuna, 2 highly regarded up-and-coming prospects. Michael Schwimmer, a former Major League pitcher himself, founded the company.
The players get to choose the equity they'd like to give up in return for the money that they receive. Our kind of company motto is Big League Advance, by players, for players. So we might have a scale of $1 million for 10%, but $100,000 every one, and the player can say, okay, I'll do $300,000 for 3%. So our average deal is in the $300,000 to $500,000 range.
A typical minor league player might make less than $10,000 a year, so getting an upfront payment of $300,000 could be life-changing money. as several superstar players, including Bryce Harper and Manny Machado, recently signed contracts each worth over $300 million. Earning a small percentage of a contract like that would be a big win for Schwimmer's investors. The company's model is just like venture capital, losing a small amount of money on most investments with hopes that a few superstars can make up for all the rest.
If you invest in 10 tech startups and 1 or 2 become Facebook and Google, you're going to do pretty well, even though the 8 or 9 miss. And that's how we do it, just for baseball players instead of tech stocks.
One benefit of this type of investing is that baseball salaries are not correlated to the whims of the stock market. The catch, though, is it requires investors to be patient.
It's a very long-term investment. You're not a free agent until 6 years with a major league team. You're seeing that with Bryce Harper now and Manny Machado and others. And so the tail is very long. So on an individual player investment, we're not expecting a return for at least 6 or 7 years.
For Nightly Business Report, I'm Eric Chemi in New York City.
And before we go, one final look at the day on Wall Street as we get ready for the end of the first quarter. The Dow today rose 91 points. NASDAQ added 25. The S&P was up 10 as traders watch very carefully for developments out of Beijing on those trade negotiations in China. And tomorrow we'll see how the Lyft IPO does on Wall Street as well. That's Nightly Business Report for tonight. I'm Bill Griffith. Thanks for watching, everybody. We'll see you tomorrow.